Are you still managing enterprise risks in scattered spreadsheets and siloed reports that no one reads? Today, risks change faster than ever, and leadership needs a single, reliable view of what really matters across the organization. Cygnus Nexus Enterprise Risk Management brings all your risks, controls, and action plans into one integrated platform, so you can move from reactive firefighting to proactive, data-driven decision-making. With Cygnus Nexus, you can gain a 360-degree view of your organization's risk landscape, align governance and compliance, adapt to shifting risk appetites, regulatory changes, and strategic priorities. An intelligent enterprise risk management ecosystem that transforms the way your organization identifies, monitors, and mitigates risk. Centralized risk intelligence. Gain a single source of truth for enterprise-wide risk management. Proactive risk monitoring. Stay ahead of threats with continuous monitoring and alerts. Control and compliance management. Ensure compliance and control effectiveness with built-in RCSA tools. Incident and loss governance. Respond and learn from every event. Security and audit readiness. Protect data integrity and ensure regulatory confidence. Intelligent dashboards and analytics. Empower decision-making with real-time data visualization. The result? Stronger governance, fewer surprises, and better alignment between risk, strategy, and performance. Your teams gain one source of truth, auditors get clear evidence and audit trails, and management gets forward-looking insight instead of backward-looking reports. If you want to modernize your risk management and make informed decisions with confidence, explore Cygnus Nexus Enterprise Risk Management with Crow UAE and see how it can fit your organization. Book a demo. Cygnus Nexus. Smart risk management for proactive and informed decision-making.
Good morning, all of you. First of all, thank you all for joining the virtual panel discussion on building risk resilience in geopolitical uncertainty.
Crow UAE is a part of Crow Global, which is one of the top 10 consulting firms in the world with a 6.5 billion annual revenue. We have presence in more than 141 countries. Crow UAE starts its operation in UAE since 1981 and completed more than 4 decades of service here. We have 5 offices and more than 600 professionals are working under 12 divisions. Crow's GRC division is instrumental in supporting entities coming under different regulators like Central Bank of UAE, FSRA, DFSA, CMA, VARA, etc. to comply with various regulations. We support the entities for consulting advisory services of governance, risk and compliance, cybersecurity services, trainings, internal audits, financial audits, tax, etc. Our technology division is assisting clients with various GRC solutions like sanctions training, transaction monitoring solution, digital KYC solutions, etc. We also launched our enterprise risk management solution, Cygnus Nexus, which help you to automate your risk management easily. Currently, more than 1,000 customers are using our technology solutions in this market and other GCC markets. Once again, thank you everyone for joining this session. And now I would like to request Ms. Reena Matthew, our Director of Digital Academy, who is the moderator for today's session, to start the session. Over to you, Ms. Reena.
Thank you, Mr. Manoj. Once again, good morning, everyone. A warm welcome to the panel discussion on the building risk resilience in an era of geopolitical uncertainty. As he mentioned, my name is Reena. I'm the Director of Digital Learning in Crow, and I will be the moderator for today's session. Before we begin, there is few points I want to remind. Please keep your microphones muted throughout the session. We will reserve last 20 minutes for audience question and answer. You can drop your questions in the chat at any time. We have approximately 90 minutes together. Let's begin. Over the past few years, organizations across the globe have been navigating an increasingly complex environment shaped by geopolitical tensions, cyber threats, supply chain disruption, ESG expectation, economic uncertainty, and dynamic regulatory frameworks. Today, resilience is no longer about reacting to disruption. It's about anticipation, agility, governance, technology, leadership, and the ability to adapt continuously in uncertain times. To help us to navigate these important themes, we are privileged to have with us three highly experienced industry leaders. I would like to introduce our first panelist, Mr. Varun Jihani. Varun is a chartered accountant with 17 years in financial service across ADCB, Citibank, Postpay and E&, which known as Etisalat before. He currently leads risk and compliance at E&, Money, overseeing end-to-end governance including financial crime and making him uniquely placed to speak to the front line of compliance in fast-moving environment. Our second panelist, Mr. Shabrish Rahman, he is the risk management professional with nearly 20 years experience, including 10 years in the UAE, across the financial services, payments, telecoms and regulated market infrastructures. As an FSRA approved risk officer in an ADGM regulated entity, his voice of operational and regulatory resilience. Our third panelist, Mr. Anand Unatkar, he is the head of credit and ESG risk at United Arab Bank with 10 years GCC experience. Having led risk strategy at First Abu Dhabi Bank and an advisor to early stage ventures and alternative investment funds, he sits at the intersection of credit risk and sustainable finance and a perspective that is increasingly central to how banks think about long-term resilience. Welcome all the panelists in the talk show. Today we will move through four themes. One is the micro geopolitical risk, operational and strategic resilience, technology, cybersecurity and ESG, and the last, leadership and future outlook. Let's begin by looking at the bigger global landscapes. Over the last few years, geopolitical development have moved from far beyond headlines and now directly influencing how business operates. Let us explore how organizations are adapting their risk strategies in response to this constantly evolving environment. My first question to Mr. Anand: how are shifting global supply chains and macroeconomic realignments prompting UAE banks to recalibrate their credit risk outlook and investment assessment models? Mr. Anand?
Thank you so much, Reena, for the opportunity and starting us off with such a relevant question. Now, before I dive in, I just want to quickly thank the audience because taking an hour and a half of your day, and we see the participation over 100 people now. This really shows the commitment as well as the relevance to the landscape that we are discussing. And also me and my fellow panelists will try to make sure that it's worth your time. To answer your question, see, as a risk professional, we look this strictly from the mathematical point of view, right? So when we see any geopolitical events or the issues, this equals to a friction, and in the business balance, friction equals to extended working capital and the squeezed cash conversion cycles for our customers or the obligors for that matter. Now, see, with the rapid change that we are seeing in terms of supply routes or the maritime routes with the ongoing situation or the macroeconomic realignment that we have seen in the region for an extended period of time, fundamental principles of the risk management or the credit risk management have not changed, right? But our execution has had to evolve drastically. So, for example, let's say historically for the credit risk assessments, we used to rely heavily on the models, right? We used to look at the vintage 10, 20, 30 odd years of data to understand that what will be the default, what will be the recovery data. And we come up with something statistical model, we call it probability of default or the loss given at default, which is PD and LGD. Without going into technicalities, See, today also we look at the models to estimate the obligor's creditworthiness, but now instead of purely calculating, let's say, probability of default, now we have also started assessing the time to survive, whether this client in the manufacturing or the trading will be able to withstand the sudden, let's say, 60 days of delay because of the delay into the routes or any other reason, right? And this has become the heart and the core of every discussion now. So, I mean, previously what we used to rely on the models heavily. Now there is also the element of expert judgment, what we call expert or the in-house judgment. But that being said, see, we have to acknowledge the environment we operate in, right? So we are into an incredible fortune. We are incredibly fortunate to be sitting in a country with deep structural cushions designed to absorb exactly this kind of shocks, right? When we talk about the UAE, and if you, let's say, talk about the banking sector, our capital adequacy ratio, what we call it CAR, is well above 17%. Now, this kind of liquidity or the capitalization actually means that sector can genuinely withstand the immense volatility. And for that, I think we all have to have a deep gratitude and the foresight of the country's leadership, as well as the pragmatic framework set up by our regulators, may it be whether it's a central bank of UAE or all the relevant or the competent authorities for that matter.
Thank you, Mr. Anand. The next question I'd like to move it to Mr. Varun. How has the current geopolitical volatility fundamentally shifted your industry's approach to high alert compliance?
Thank you, Reena. Good morning, everyone, and I'd just like to echo a big thank you to everybody to what Anand's mentioned earlier. Great audience, and I really look forward to this session. Coming to the question, I'm not sure if we call it geopolitical volatility or we call it geopolitical gymnastics, right? There's so much of push and pull going on across the world. Anyways, from a broader lens, I've always been a vocalist about the role of risk and compliance and the governance function. It's to be an enabler and not a blocker, right? And people who know me well really get this. Geopolitical volatility hasn't just adjusted our compliance posture, I believe. It's fundamentally restructured on how we think about risk as a business function now. So compliance is no longer a back office obligation, I'd say. Yeah, it's now a frontline, broad level strategic priority. Now, backdrop is the regulator of the UAE, right? We've seen the intensity has accelerated in recent times. The UAE has issued over 339 million in fines to banks, exchange houses, insurances in 2025 for various AML CFT breaches, with regulators also scrutinizing shell companies, crypto-based flows, etc. Now, it's not really a warning shot, I'd say. It's a statement of intent, right? We've also seen other regulators follow. So Dubai's WARA has also released a version 2.0 of its rule book in mid-2025, expanding governance as also the reporting standards. I think the key themes of changes that are applicable to us as well as all in other industries too. Once regulatory engagement is proactive, it's not reactive, right? Now we need to build tools to ensure that shut door on every AML CFT threat that hits your view. A robust onboarding and continuous screening needs to be in place. Second, I think the static policies should not be static anymore. It should be dynamic, right? It requires an overall culture shift to think about intelligence-led control and not the elementary static controls that we've seen all this while. A lot of new tools are available today. Device fingerprinting, IP, geofencing, a lot of these advanced tools which I've personally seen in my career, and we also actively use it. Further, what I've seen change concretely is third-party and corridor risk, right? I'll just spend a couple of minutes on this. So a focused and tailored approach on both of these risks categorically. Corridor risk is specifically applicable to suppliers, exports, remittances, etc. I mean, different businesses, different corridors, right? But for a few, it might be a UAE India corridor, Pakistan corridor, for example. I think a fit for purpose monitoring plan with a tangible action is the right approach to the high risk alerts and compliance, I'd say. Yeah.
I think it's a very good view on that, the corridor risk and everything. That's very good you explained it. So the next question is moving to Mr. Shabarish. With sanctions lists updating almost in real time, how you are solving the challenges of flash sanctions enforcement without halting legitimate trade?
Sure. First of all, thank you to Crow and the entire team for arranging such a wonderful discussion. And I echo with what Varun and Anand spoke about the audience who had turned up for the discussion. We'll try to keep it as engaging as possible. I also want to really appreciate the effort behind this. Reena, you're doing a wonderful job in holding this together. So getting back to the question, so we need to understand we are in a world where flash sanctions happens, as the name implies, right? It can happen anytime. Gone are those days where you have the overnight batch screening. Like, for example, we used to have this screening done by the end of the day or the beginning of the day. So you don't want to get into a situation where the entity is already sanctioned over the night or in the mid-afternoon and you see that the next day morning. So you don't want to have such a scenario. But then you could say that there are tools in the market. There are a lot of tools which can give you a near real-time monitoring and that can help you to do that. But then it comes with a headache, right? In the sense, when you have such a tool, it can also bring in a lot of false positives. And if your volume is massive, that's going to be a bigger headache for you. So the bigger your organization, the more complex your data is. Then what could be the solution for this? We need to look at it from a client profile perspective. See, for example, if you have a lot of retail customers, you need to have a specific tool for that. And then you have your complex corporate structures, you need to have a specific tool for that. More than the tools, I think what we need to understand is we need to have an internal risk threshold set up. In the sense, you need to understand what is the risk you're taking, which is defined as part of your risk appetite. And unless we know that, we will not be able to set risk thresholds. So the solution is not just having a tool in place and ensuring that your solution is done. No, it's not like that. It's a combination of having the right tool and also to understand what is your risk appetite so that you can place your threshold properly. At the end of the day, you don't want to, what Varun said, that we want risk to be an enabler, not a showstopper, right? So you need to have the legitimate trade should flow on, but at the same time, you need to have the assurance in place that what are the right red flags that are being highlighted. You need to know the layers of how you're going to place your policy, and on top of that, the machine learning, which could be an AI tool. So the solution could be a combination of having the right risk mindset along with the right tool, and then going ahead with the implementation. Yeah. At the end of the day, the goal is not having precision, right? It's having precision, not paranoia. So legitimate trade should flow, and the real risk should get caught.
Thank you. Good to know about the tools and everything, which we will discuss soon in our third segment. Let's move on to the next one. So while global uncertainty creates external pressure, resilience is often tested internally. Let us know how organizations are strengthening operational resilience while continuing to grow, innovate, and maintain customer trust. My questions to Mr. Varun. In times of uncertainty, how you align strategic growth ambitions with risk appetite and regulatory expectations?
Thank you. I think the premise of aligning growth with risk appetite implies that these are two separate things that need to be reconciled. But what I'd say, it has to be in conjunction, because I mean, you cannot drive your car looking in the rearview mirror, right? It has to be in alignment. It has to go together. The most resilient organizations, what we've seen operating in the UAE, have stopped treating risk appetite as a constraint on growth, and it started to be used as a design input for your growth strategy, right? A few points. I think the first is the risk appetite should not it has to be explicit. It should not be assumed. Now, too many organizations have risk appetite statement in a document. I think people in the audience would resonate, and that nobody refers to when there's a real decision making that happens, which is either you're entering a new market or a product launch or partnership. The need of the hour is to make a risk appetite more like a live, a board level input into the strategic planning cycle, and not as an annual exercise. So from a practical business perspective, it should be a risk-weighted growth pipeline, I'd say. You rank markets, products by risk-adjusted returns, and in risk terms, to what Anand mentioned earlier, probability of defaults, etc. Regulatory aspects, as also data mobility with UAE requirements, and you put stage gates which are either kill switches or tame and go ahead. Second is the regular engagement. So we should be treating regulators as strategic stakeholders and not as referees. The organizations winning in this environment aren't really waiting for the rule book to be finalized before they move. They are actually in the room with the regulator and helping to shape it. And the third aspect, I'd say, is scenario planning, which has replaced static risk registers. In a volatile geopolitical environment, the question isn't what's our risk. It's which of your growth bets survive which scenarios, right? And we must run these strategic decisions through multiple geopolitical and regulatory lenses before we commit capital, headcount, etc. Through this, we also need to define real-time guardrails, right? I think in summary, you stop aligning growth and risk appetite as if they are opposing forces, but a strategic planning process where they're the same conversation from day one. You embed controls into the product life cycle, and yeah, you earn your right to grow by proving that you can tighten the screws or unwind the risk very quickly. That's it.
Good. Thank you. I think for the operational resilience, Mr. Shabarish, I need to get your insight on it. So operational resilience is often measured by frameworks and systems, but how much of it comes down to risk culture within an organization?
Yeah, I think my first question was, my response was more to do with the framework implementation and the tools, right? So this, I'm going to flip it the other way around, because I think, and all my panelists will agree to me, that the best tools in the market or the best framework that you can implement, if you don't have the right mindset, it's going to be a failure, or it's going to be a tough road to go ahead, right? And this might look very simple, but the problem is that risk culture is always overlooked in terms of when you talk to a board or to a senior management. Risk culture is looked as an annual awareness training session where you do it as a tick box exercise, rather than it is embedded into your belief and the working culture, right? And if someone asks me, how do I do that? It can't be done in a day. It can't be done in a month or a year. And I truly believe that you need to understand where it starts. If someone asks me, okay, Sabresh, I want to have a good risk culture in my company, it starts from the top. It starts from the board and the senior management, and it cascades to all the employees in the company. And whatever we're going to speak, behind that topic, you're going to have this mindset where whatever we implement, whatever we try to execute, if you don't have the right risk mindset, and what even Varun was also highlighting about proactive risk management, all these comes as part of your risk culture. So that at the end of the day, risk is all about timeliness and transparency, right? If you don't have the right data on the right time with transparency, we're just doing compliance or just for the sake of doing it. So I think we need to move away from looking at risk as a risk manager's job and compliance as a compliance manager's job, rather than all of us play a role in that equally, and it's a combined effort. So I think, yeah, the question, operation resilience itself, is that, what do you mean by operation resilience is when something bad happens, how quickly can you come back to your field and how quickly can you continue the business. When a crisis happens, tools and frameworks does not respond. People respond to it. So if you need to have the right mindset for you to have good resilience, and that's what I strongly believe that we need to focus on. Given the massive growth that we have in the UAE market, I think this is an area which I strongly believe that all of us need to look at it in a more effective way than we do right now.
Thank you, Shabrish. Good to know that about the right mindset and the risk culture, which is the more convenient in that operational resilience. My next question is to Mr. Anand. A few years ago, resilience meant your backup servers are running. Today, the threats looks completely different. In your experience, how banks strengthen operational resilience while maintaining strategic growth, customer confidence, and regulatory alignment?
Well, Reena, you have actually hit the nail on the head, right? 10 years ago, when discussions around the operational resilience was basically just, merely the IT budget discussions, right? IT or information security or the ops budget discussions, right? We would point out to a backup server in some other emirate and call it a disaster recovery. The classic debate was simply the cost versus resilience, right? Today, that paradigm has completely shifted. The trade-off actually is now we are wrestling continuously with the speed versus control, right? So organization in this competitive world and with the advent of AI are now under immense pressure to release the new digital launch, new features, tap into new segments at the lightning speed, right? And actually and truly speaking, we are probably competing against probably some Gen Z or Gen Alpha vibe coder operating from his or her own basement, right? So we are literally competing against that. But for the organization, how do you maintain governance or the control when we have to move faster? And that's actually the core issue, which we all the organizations are trying to address, right? So see, to achieve that speed, organization need to essentially outsource chunk of their execution to a global cloud, let's say cloud providers or the SaaS platform or the fintech partners, right? So, for example, my all co-panelists are kind of my partners in terms of various activities that as an organization, let's say as a bank, we would have probably outsourced, right? So our digital walls are actually highly permeable. And the reality is that if any third-party vendor goes down globally, let's say, then the corporate client, let's say, sitting in Dubai would not blame the vendor, but they would blame the organization or let's say bank, because and right to do so, because ultimately we are supposed to manage that, or we are supposed to maintain that. Right? So now we have had to change our architecture, right? We no longer design for an impossible 100% uptime. We design for like what we call it internally is graceful degradation, right? So meaning that if any peripheral system any peripheral element of our service goes down, how do we isolate that failure so that instantly we ensure that core customer transaction or the customer satisfaction doesn't get impacted? I would always give this analogy that see in schools we study in physics about the series connection and the parallel connection, right? So in series connection, one of the major drawback was that if one piece of the element is not working, all your subsequent parts won't work, and that's exactly the benefit into the parallel connection, right? So we are into that stage where we have to find out these pockets about how we can optimize it further, how we can, and that's all right now the resilience means, like, more of, it has become more of an art, and the role of the risk management is, again, this we used to discuss with our team, and my boss used to give this analogy that the role of the risk is not to build the heavy brakes, right? To stop, let's say, organization from innovating. Our job is actually to build a strong guardrail so that business can drive at 120 km/h speed, right? And safely. That's the role. Last point, what I would say is that, see, again, operating into UAE is, I feel, again, the massive advantage to us. Like central banks or the regulators over here completely understand the requirement of the speed. If you see, they are always on top of everything while ensuring that they have adequate governance framework controls in place, right? For example, let's say they ensure that we are allowed to outsource few of our operations, but also ensure that the right governance stress test in place so that any time any event happens or anything go to south, we don't actually eventually ended up impacting the broader scheme of things. So yeah, while we have to roll out few new features or at hyper speed, but we have to, while keeping our operational resilience and the customer trust absolutely bulletproof.
Thank you so much for a detailed explanation on that point, Anand. Before we are moving to the next session, I would like to inform all the participants, please drop your questions in the chat at any time. At the end of the session, we will take that questions to the panelist. All these two sessions, everybody discussed about the tools and technologies on the risk. So let us now look on the tools and technologies shaping the future of resilience. So as the organizations become more digital and interconnected, resilience is increasingly dependent on technology, cybersecurity, data intelligence, and sustainable risk framework. Let us understand how organizations are leveraging these capabilities to build resilience in future. My questions to Mr. Shabarish: in today's threat landscape, how should organizations rethink their approach to cybersecurity beyond the traditional compliance framework?
Okay. Thank you, Reena. So I think before I want to answer this question, I would like to start the answer to the question that do the organizations even have a cybersecurity cyber strategy in place? Because most of the companies have business strategy. Because what I see more often is cyber sitting as a line item under IT, and it is treated as an IT risk rather than a business risk. It's called as a technology problem, right? And that's the first issue. Think about it. For example, when there's a cyber incident, who gets the call first? It would rather be the IT team, and sometimes I feel that it dies down within the IT department. When there is a board meeting, who's presenting your cyber risk? Is that the CIO who's doing it, or is that the CISO who's doing it? So the problem, what we have is the what I would like to call it that again, I go back to the discussion what I spoke earlier, that it is the mindset that we need to change when we look at cyber risk itself. Because if you look at the recent 2-3 years, like since 2023, we had about 250% increase in the cyber attacks, particularly in the region that we are operating, right? And if you look at the kind of attacks that has happened, it was not just data breaches. They were specifically, for example, you had attacks on the payment system, you had attacks on the trade finance platforms. The goal was not just to breach your data; it was also to stop from operations. They had a DDoS attack, which is not just a pure technical issue, but to stopping the service to the customer, right? It becomes an operational issue, it becomes a business risk for the organization. So I think I would like to have the cybersecurity looked at more of a business risk rather than an IT risk. So you need to have that shift from a IT department to a boardroom, need to have dedicated strategy in place, and not to have to appoint an external vendor or someone to come and do an annual cyber security assessment who comes up with the score, and then you do it again the next year. We are in a world of AI where things can happen so fast. So we have to be proactive in terms of handling such cyber exposure. So yeah, I think this is what I would like to highlight from a cybersecurity perspective.
Thank you. Mr. Varun, I think you can answer the next question. In an era of high velocity threat, how are you leverage latest risk automation to move beyond manual detection and achieve real-time resilience against sophisticated financial crime?
Oh, I think Anand, you raised your hand. You had a point to make.
Yeah, I just wanted to echo what Sabri has mentioned, right? And this is, I mean, what he has mentioned is very, very relevant, where, I mean, we have to look at the things in toto, right? From the enterprise risk perspective. And this is not just applicable from the non-financial risk point of view. The way we divide is financial risk is typically a credit market liquidity, and non-financial typically it's operational resilience and information security and so on and so forth. But right now we are at such a juncture, and that's why I wanted to just add to what Sabrish has mentioned, that even when we are assessing or when we are developing from the financial risk point of view, also we have to consider the non-financial risk aspects, and it is not at the systemic level, but it's actually at the idiosyncratic level. For every obligor or every customer also is being assessed throughout this 360-degree view from the enterprise risk perspective.
Thank you, Anand. It's a very good contribution on this topic.
Yeah, I'd also like to add a point there, Varun, if you allow me.
Please.
And frankly speaking, you could also see this, that a company who onboards a client or a customer have to perform a client assessment or we call this an onboarding assessment, which is a pure compliance requirement. Yeah, KYC. But unfortunately, I'm not sure if the KYC approach or the client assessment talks to the overall risk assessment approach that the company takes from enterprise perspective. So it is always looked at as a separate activity between, even being a second line function of compliance and risk. Even the second line not being aligned is a bigger challenge, right? You leave the first line aside, but even from the second line perspective, even from your area, Anand, you can agree that even from the credit risk or the ESG part, the holistic view is lacking, is what I'm thinking. Yeah.
Absolutely.
Yeah,
absolutely.
Just want to add this point. Varun, go ahead. Sorry to interrupt.
Sure.
It's okay. So when the question is displayed there,
yeah,
so do
I recap the question? It's about leveraging latest risk automation to move beyond manual detection. Yeah, I think if you ask everybody in the room, I bet everyone will say they have worked on automation, right? I don't think the question is really about just automation. It's about whether our detection posture is built for the speed at which the threats now move, right? In traditional AML systems, for that matter, you'll see up to 95, 97% of the alerts are false positives. And it's just building a single, SAR report can take more than 4 or 5 days, etc. This is not really a compliance function. I mean, I'd say this is more like a noise machine, right? Every hour of compliance analyst that spends clearing these false positives in an hour, a genuine threat can just move undetected. So I think the biggest one is to a fit for purpose tool that is able to stitch the missing pieces and clear the noise. Then I think the second piece would be the closed loop automation, where you also have a human in the loop where it matters, right? And this is critical because human judgment itself remains critical, especially at the point where your detection becomes your decision. You assessing the credibility, weighing evidence, interpreting context with high level background, including diving into the specific customer needs. Now, all of these are still inherently human tasks. So automation can handle data validation, identify inconsistencies, etc. But once the facts stop being clean and straightforward, I think someone still needs to review this and stand behind the decision that's made. Personally, I'd say what I have built and seen in practical use is AI agents, also in terms of processes. So robotics process automation, we call it RPA popularly. Now, practically, this does every piece of transaction monitoring that an individual would do. It would detect sophisticated patterns, layers, etc. And another piece that I've also co-built and experienced is machine learning algorithms for instant credit decisioning. Anand would also resonate to that because the fact is the ease of credit that you want to develop today, and it all comes with automation. So you need to focus on, I'd say, the Pareto principle, which is also known as the 80-20. So you spend 80% of your outcomes would come in from 20% of the causes. So if you are aligned on those 20%, then your outcomes will be amazing. And yeah, I think in a nutshell, the firms that will define what resilience looks like in the region are the ones that have automated the most, and they are the ones that have automated the right things with the right governance in place. So real-time resilience isn't just about you purchasing a technology. It's about an operating model that needs to sit and fit well in the organization.
Good. Shabrish, you would like to put some insight on this?
Yeah, I think I would want to ask Varun, because he raised a lot of valid points there. Varun, I just wanted to understand, specifically from the risk automation. I know you spoke about RPA, but now that we are in the AI world and AI is being looked at, we need to start embracing it rather than going away from it because we can't avoid it, right? How would you adopt the AI technology into risk management in terms of, and how could we, proactively start looking at using it for risk management specifically? I thought I'll ask this question.
Sure. Yeah, no, great point. So what we do is, instead of having a human as a particular individual who's sitting and running through scenarios, you hire an AI agent, right? You are either hire externally or you build yourself. We as an organization, we've built ourselves. So you built an AI agent that would run through all of the scenarios in parallel. You don't even need to trigger a command. You need to pre-configure a command at the back end saying, if there are A, B, C, D scenarios that run, just throw up an alert to me, which is then validated by the human who comes in and sees whether the alert is genuine or no. And a lot of these AI tools, machine learning algorithms are such wonderful tools that they learn over time. So we've also seen the false positives thrown by these tools are immensely low, absolutely low. So a thorough report comes into your inbox. It's just your job as the head of risk or head of compliance to just run through it very quickly, decision and move ahead.
Yeah, in fact, I was reading an interesting concept where instead of you hiring a new person into your team, you train the AI agent who ends up becoming more experienced the more you train the model, because it studies your behavior, it studies your brand value as a company, and accordingly you can then tailor it to your requirement. And it was an interesting concept, right? So we're looking at a very new way of working culture in the future, where we might have a 10-member team where like 5 members are specific AI models and 5 members are humans. So it's going to be a very interesting future, I guess.
Yeah, like it or no, but I think 50 to 60% at least of the operational jobs are going to be taken away like this. Yeah. And it's like coming here. We can see that in maximum 2 years, I'd say, not even longer.
Yeah. So Varun, in that case, probably in future, by that logic, probably few AI models would be sitting in our place and discussing or having a podcast.
So that's where the risk culture comes in the picture, Anand. So we still have that part in our hand, So yeah. At least we could say that for the next decade or so, but we never know what's going to happen. So we'll see how it goes.
That's good. Good to know that, everyone is talking about the future and everything. So I would like to ask these questions to Anand about the next generation's risk professional. Having worked at the intersection of credit and ESG risk, what is the one piece of advice you would give to the next generation of risk professionals in the UAE who want to build a future-ready career in this space?
That's fantastic question, and I think this is, and I'll be candid about it, right? So this is the same discussion we frequently have with our team and also with our bosses, right? See, if I had to distill it down to one piece of advice, it is that stop acting like an auditor, but start acting like a commercial or the business partner, right? No offense to the auditor, but But the typical mindset of the risk, or historically, risk department was always viewed as department of no's, right? And with the rise of the new development, it's easiest thing to do, right? I mean, for example, let's say we also manage the climate risk, and for me, it's the easiest to say no, that client does not have the carbon footprint data, and hence I don't want to, let's say, lend to the client, right? But I think this is just an analogy, but the future ready, I think professional is like, the way I see it is like more of a translator, right? Like we have to sit across along with the relationship manager or the guy who's getting the business, who's fighting his or her tooth and nail for the transaction, right? You can't just hand them over 50-pager credit risk or the risk or the climate report and state that, hence we can't progress, right? We have to we have to sit with them. We have to actually make that happen, right? And that's where, so for example, I always used to say that, for example, if organization or family-owned business, let's say a well-established family-owned business over here in manufacturing or the contracting or the real estate, doing or thriving well for the generations, I can't just merely say no just because they don't have, let's say, scope 3 emission data or the carbon footprint data, or probably with the new disclosure requirements, they don't have, let's say, ABC, right? So that it's a journey that we have to understand, and we have to support. So that's where the role of second line comes very critical, right? And that's what I think Sabrish has also mentioned in the earlier discussion, right? Only thing is that, see, for the young professionals operating here in UAE, I strongly feel that this is still the ultimate proving ground, right? We are into a region that is actively financing its own transition to the diversified economy, right? We have seen that throughout. And if we can learn to bridge that gap, taking the complex models from the risk management point of view and turning into the real life deal structuring, that you are part of that structuring, that how nuances are made, that how prices are being determined, and you know each and every element of it, and you can support the business throughout while ensuring the governance and controls in place. I feel like, then you don't worry much about your career or AI taking your jobs, because then you will have your permanent seat at the table.
Good. Varun and Sabrish, would you like to put your insight on this?
I think Anand's well articulated.
Okay, good.
Yeah, I think same with me also. It can't be just from a perspective of ESG alone. So yeah, I agree to you, Anand.
Thank you. So beyond systems and frameworks, now resilience is ultimately driven by leadership, culture, and ability to prepare organization for the future. In this final segment, we will look at leadership priorities, organizational culture, and the future look for risk resilience. Before we are asking the question, once again, I'm reminding all the participants, please post your questions in the chat so we can take it up after this session. So the questions to Mr. Varun, how do you maintain a strong culture of compliance among employees when external market pressure are at an all-time high?
So I think the regulator has already done the job right here. Regulatory environment by itself, it's a great tailwind if you ask me. We don't really have to press upon this more. The press has in fact done the job, as I said in the first part when we just kicked off the fines that have been put through. But anyways, I think going to hit the point, first is the tone from the top, which was mentioned earlier, I think by Sabrish. It is necessary, but I slightly digress that it's not fully sufficient, because here's what I have learned. So the tone travels from the top slowly in a fast moving organization. What matters just as much is tone from the middle management. It's from the team leads, the product managers, the people who are making daily decisions that actually never reach the executive level. And if your middle management layer treats compliance as a blocker, then that message reaches the front line far faster than the leadership. So you actually need a springboard into buy-in from all the functions, and also comes in from the middle management. Second is around psychological safety when it comes around raising concerns. And I keep echoing this every time, that we need to embrace risk and not escape risk, right? So it is essential for every employee to feel empowered to voice their compliance concerns, suggest improvements. And these are, it should be escalated to senior management as well as chief compliance officer, on need basis. Now, in a high pressure environment, the biggest cultural risk isn't people breaking the rules consciously, it's people staying silent. When you notice something is going wrong and you don't speak up, that's a big problem. So building a genuine speak up culture is harder than any technology investment, but it requires leaders who respond to concerns with curiosity, not defensiveness. And I think the third one is the compliance training, which is more like an annual event that you would see on and off in possibly every organization. What we need to do is make it a bit more casual, conversational, so call it Gen Z, Gen Alpha, whatever we say. So it's we've come up or introduced this concept of coffee with compliance. So you have a fireside chat with the individuals of the company, so they understand. Again, bringing back the point home that compliance is not a blocker, it's an enabler. The shift that's required is moving beyond the annual compliance training towards, so to say, AI literacy, real-time behavioral monitoring, adaptive training that strengthens the weakest link, whether it's staff or it's even external customer effect. So culture is, I think, what your systems, people, and the stories they tell. And here is the point where you start building a pyramid from the tip of it, right? Laying the foundation from there and then trickling down. By hard wiring guardrails into workflows, paving a way for growth even when the market heats up. That's about it.
Good, you mentioned very well about that, the importance of training, especially when you mentioned about the next generation. So the traditional training methodology has to change it into the new methodology. Like when you mentioned rightly that the coffee meeting with them, so discuss with them, because they don't like to learn on the traditional methodology of the learning. So like,
Right.
make them as an enabler. I think constantly we needed to remind them where to focus on and how to go on, whichever the next generation which is coming. I know the attention span is reducing it.
Yeah, even for trainings, when you throw up these questions and you would probably go back and see everybody's internet history, people would, I bet my life, they would have done a chat GPT on each and every question these days. Get an answer, reply, and move on, guys. Let me
It's
get done
true.
with this quickly.
You're right. It's rightly said. Thank you. So the next questions to Anand. As ESG transitions from the compliance exercise to strategic driver, what are the most significant systematic challenges bank face in embedding it into credit risk? And how is the UAE banking sector uniquely positioned to lead in this space?
See, when it comes to climate or ESG, ESG is a very broad topic, right? I mean, we are talking about three pillars like environmental, social, and governance. And to be fair, SNG was pretty much into the picture since a few decades now. It's the climate which actually picked up pace with the various conventions and the COPs that took place, right? Let me be brutally honest or candid about it, right? So practical reality of ESG integration is like it's incredibly easy to draft a beautiful glossy ESG policy, at the board level. And nowadays you just put a prompt in Claude or GPT, and then it will give us the full-fledged document. But it's incredibly difficult to execute it on ground when you are actually underwriting a loan, right? So I think the single biggest challenge that we face globally, I think, and I think everybody in the audience as well as in the panel would agree, is that data when it comes to the climate or the ESG, right? And it's See, it's a great intellectual exercise to build a pristine ESG credit model or the climate model. But when you are dealing with, let's say, mid-cap, family-owned manufacturing or the contracting or the real estate business, they simply would not have that verified data, right? What you are asking. So immediate danger that I feel, if we face as an industry is that if we rigidly follow or enforce that global ESG compliance metrics without any nuances, right? So we are going to then accidentally choke off the capital of that real economy. Those are the pillars of real economy, right? And then it rolls up. So we cannot stop lending to good functional business just because they are trying to catch up with the reporting standards, right? So, and this is exactly where your second part of the question is that, UAE banking sector, at least that I'm privy to say, is that uniquely positioned to lead this. We are not burdened with any kind of ideological gridlocks or the decades of the legacy green tapes that were in a few parts of the world, right? What we have is I would say, I would put it this way, that it's a pragmatism over dogma, right? Because top down, there is a clarity, right? We have a 2050 initiative for the net zero, right? Then the regulators are also, if you see the various regulations and the practices, every regulation comes invariably with a journey. And there is a journey that, the regulators have set up for the economy or the global level or at the country level. Also, they have given us the option that every organization also largely choose their own path, right? Because it's very niche or individual to every organization, right? So we are actively allowed to use our balance sheet to fund the transitions, right? So that's the key, right? We have to fund the transition. Then only somebody has to do it. Then only that the transition would happen, right? Holding our clients' hands through the process rather than just using the ESG as a kind of compliance stick to penalize them. So I think that pragmatic growth focused approach to the sustainability or the climate, at least so to speak, actually will lead the space. And I'm happy to say that UAE is into that journey, and it's probably the case study for across the globe.
Thank you, Anand. Shivresh, the final question to you.
Yes, Reena.
Yeah. What does a truly resilient organization look like in the Middle East financial ecosystem?
That's a very big question that you asked me, which doesn't have a single answer. But I think as we were discussing, I was just reading through the chats, and I saw the chat from Horst Simon, who is also he's a known risk professional, and I was reading through his phrase. Horst, I'm going to quote the Warren Buffett quote when I give my response. But moving on to the question, Reena, I think we already have the discussion that's been happening for some time now, and some of the tips given by Varun. I really liked the coffee with compliance program, Varun. It's really something that I would like to have it in my company also, and I think that's where the culture brings in, right? In the sense, you need to bring in not risk as a bad thing, but also you need to bring in the recognition and the rewards for risk management. Unfortunately, we don't have such a thing as we speak. So for me, this is the genuine belief. A truly resilient organization is one that embeds that strong risk culture, and everything, your tools, your automation, the AI, the framework, it's only as good as a mindset, and that's what we've been discussing the entire session today, if I'm not wrong. Like, let me give an example to you. Like, for example, you have the most advanced sanction screening tool in the world, and if that person is reviewing the alert and it's happening on a Friday afternoon, and the feeling what we have on a Friday afternoon, right? If you just want to clear it quickly because of the weekend, or you want to plan something, the tool means nothing, right? That's a cultural failure, not as a technology failure. And also we need to understand if the person has the ability to escalate it the right time instead of fearing that his or her job might be at stake. And this is where, Horst, I'm going to quote the saying from Warren Buffett that he said that in business, we focus too much on the windshield, ignoring the rear view mirror, right? But I think I will flip it in the sense, I genuinely believe that if you want to become a truly resilient organization, you need both. In the sense, you need to look back properly, honestly, to learn from your lessons, and not to blame people, not to pinpoint fingers at a person that this is because of you that went wrong and like that. Rather to learn genuinely from the mistake what has happened, and also to look forward to anticipate what's coming. Because see, we've been discussing about Gen Z, we've been discussing about AI, so we cannot avoid these new technologies, right? You need to learn to adopt these new technologies. You need to start looking ahead rather than saying that this is the fundamental I've been following for so many years and I'm going to keep doing that. I would rather say it is a combination of three pillars. The first pillar, as we've been speaking, is your mindset, the risk mindset. That should be your belief, the culture that you build in, and then the fundamentals of what you want to do. How are you looking ahead in terms of implementing this? The belief turns into an execution or executable plan, and then comes the new technology on top of it, so that you can make it more not manual dependent and more efficient in terms of having the right tool in the right place. And when we talk about resilience, you need to understand that UAE is at a top 10 global financial hub right now, right? The capital flows and the regulatory evolution that has happened, the pace of growth that we have, it's remarkable to the part that of what we've reached in a short span. And I think we can say that UAE itself is a great case study in resilience. Like, this is a nation that sits in one of the most geopolitically complex neighborhoods, right? And we need to understand, in spite of whatever is happening, it has consistently maintained the financial stability, the regulatory credibility, and the investor confidence. And this doesn't happen by accident. It is not something that's happened based on coincidence, right? It happens because the resilience is embedded into the national level, in the policy, in the regulation, in the way institutions are expected to operate, be it the Central Bank of UAE, be it ADGM, DFSA. The regulatory frameworks have evolved faster than the markets. And financial institutions have thrived, the ones that we have aligned with the intent, the right intent, not just the letter of regulation, but the spirit of it. So I think with whatever that we spoke, if I have to put it in a nutshell, it is starting with the right mindset, having the proper fundamentals in place, and to embrace the new technology could be a solution, is what I think. I think I was able to answer, because it's a tough question that you asked me, Dina. So to put it all together is something what I tried to, yeah.
I know it's a very tough question, which is covering all the elements which we discussed today.
True.
That's true. So if any of the panelists would like to give your inputs on this question, it will be good. Otherwise, I will move to the next session. Good. This will come to the end of the panel discussions today. So what we are going to do now, we will take the questions, and if any of the any of the participants would like to put your questions in the chat box, it will be great, so we can discuss. And once again, we have heard a very valuable insights from all the panelists across the multiple dimension of the risk and resilience. As all of them mentioned, UAE is the resilience you have to learn from UAE, which is there, all the talk is coming up now. So I would like to know the questions. If you don't like to put it in your chat box, you can do, and then you can raise your hands and we will take the questions one by one. I have certain questions here already in the chat box, which I will going to ask it now. So can we take a minute break so I can combine all the questions together? Okay, thank you for thank you for your patience. So we received some questions. So the first question, it came as AI adoption accelerates across business operations, how are industries bracing for AI-backed black swan, cyber or fraud events? The question, anyone can take it up from the panel? Okay.
Sure, I can take off. Sorry, we have a hand raised in the meantime. Is that Mohit? Mohit, hi.
Yeah. Once that we will answer this question.